Welcome back. Now, last week at the stock exchange, the markets witnessed the submission of half-year results from Tier-1 banks that missed the 60-day window for their financial results declaration at the NSE. The lenders include Zenith Bank, Access Bank, UBA and GT Bank, all of which declared interim dividends eventually, and some from their retained earnings, despite reporting declines in their bottom lines for the period. Now, the delay for their earnings were attributed to late approvals from their primary regulators, the Central Bank of Nigeria, as the financial institutions has projected September ending as their filing period. But following the declaration of the half-year figures, however, a mixed bargain hunting and profit-taking took over the last three trading sessions that dominated the trading week as investors moved to position themselves for dividends. Joining us now to make sense of these figures is a partner at Gifted Analyst, Mr. Samuel Adebisi, who's right here with us in the studio. Good morning, Adebisi. Thanks, Mr. Adebisi. Thank you for coming on the program. Well, what do you think could have held back these banks' results with the CBN for so long, to the extent that they missed the 60-day filing period of the stock exchange?
Well, COVID-19 is a once-in-a-century event. And due to this, the CBN needs to reassess the banks, needs to check their ability to pay dividend, check if there are things that needs to be tightened, check if there are policies that needs to be put in place before they put out the result. One of those things that they need to check also is the ability to pay dividend. Try to run many scenarios, sensitivity analysis. What if profitability declines by 50% due to COVID? Will the retained earnings still be strong enough to make them operate? Do we need to recapitalize these banks? So these are things that the CBN needs to consider, and this is not something that we have experienced before in the past 100 years. So it requires a new method. It requires some time for the CBN to access this. So that's why we see these banks not making up the 60 days period.
Well, then, generally, what does the release of these Tier-1 names contribute to the markets?
Well, there are some interesting insights from here. One is the impairment. Impairment were about over the roof, but understandably, because this is a time where the COVID-19, we expect impairment to be high because some of their customers are not operating at their full level. They also will not be operating at their full level. So because of this, impairment are expected to be high. But however, I would like to put a benchmark of 100%. Any impairment charge over 100% means that there's something else that is pushing it beyond 100%. So apart from impairment, also we see all these volumes growing during this period in terms of net interest, non-interest income. Volumes are growing because these banks are trying to launch the digital platforms in a time where people cannot be together. People are trying to look for alternatives to cash. So in this period, they're able to grow volume. But looking at fees and commission income, they weren't as buoyant as we expect for a time where volumes were growing. And this all because at a time like this, the CBN decided to clamp down on the charges on electronic transfers around January. So because of something like this, for the likes of GT Bank, who have a lot of retail customers who transfer even below 50,000 naira, they will be impacted because of the fee they have to charge on it. That's how we see the likes of GT Bank recording 34% decline in this area. So these are interesting things that we've seen in this period from these banks.
Now, let's also talk about dividends. Now, we saw all the banks ending up recommending dividends to shareholders, despite some of them posting declines in profits. Of course, one would have thought that they'll heed to the advice of the IMF MD, who had suggested that banks shouldn't pay dividends during this period of the COVID-19 pandemic, of course, to boost their retained earnings for the survival. So how come we saw them declaring dividends still?
What the IMF says is general intelligence. It's only natural for us to think that, oh, this is a time for you to strengthen your buffer in case this is supposed to go longer than we expected. But it's case specific. Looking at Nigeria, some of these banks, given their performance, some of these banks have retained earnings that can pay some years of dividend if they maintain their profitability level, or if the profitability level is not as low as minus 50%. So looking at these scenarios, I'm very sure this is one of the things the CBN considered before they let them release the results, and why this result took long before it was being released. So they are at a position where, at least for this year, they can be able to pay that dividend and pay dividends. And we are seeing the economy trying to open up, which means that their customers are trying to do more transactions. The customers are trying to open up. In terms of impairment, we see them might be coming back to say, okay, you know what I mean, I'm open for business now, so I can pay you the money I'm owing you. So looking at all these things together, it seems that they are at a comfortable position where they can pay dividend, at least for this interim period and probably for the full year.
Now, let's go bank specific. Now, beginning with Zenith Bank that has its macroprudential ratio settling within statutory limits. Was that performance beyond expectations considering the impact of the pandemic?
The performance was decent. The macroprudential ratios, the NPL ratio kept within limits. The CAR, the liquidity ratio. So there are things that we do not expect this to be. We don't expect this to be bad. We expect this to happen. So that's not the main thing. Looking at other key ratios like the cost of fund trickling down to 2.2%. But then looking at things like your NIM also improving to 9%. This is awesome. However, there are other things to look at. Impairment charges increasing by 74%. This is something to be bothered about. However, I gave a key that in this pandemic, if your impairment cost is not more than 100%, I think this makes sense. We can give you that slack that, okay, this is because of this. So I think this is a very decent result. The only thing to think about is that the impairment has to be, they need to think about how to go about this impairment, how to make sure that as the economy is opening up, they're able to recover this loans, they're able to write back these impairment losses. So decent result from Zenith Bank. The only thing that was more than expected, that was beyond expectation, was the way they were able to record growth in PAT because of tax expenses.
Yes, let me talk about that tax expenses now. I was just going to ask you what role the reduced tax expenses played in the expansion of Zenith Bank's profit.
First, this is unprecedented. We didn't expect this to happen. Like, after your PBT only grew by 2%, you were able to reduce your tax expenses by 54%. But observing the tax expenses, we saw that dividend tax last year was 15 billion. This year, there was no record of dividend tax. So the assumption is to think that maybe they were able to defer the dividend payment for this year, or they were able to take it away from, because of the period they announced the dividend, we did not fall between the H1 payment. Maybe they were able to defer it to next one. But however, this is something that I know a lot of analysts are waiting to hear from them, that, okay, how are you able to do this? And other banks are not able to do it, or they did not choose to do it.
Now, let's shift our attention to GT Bank. Now, what are your takeaways from the result in spite of the relative decline in earnings? Was that decline actually expected?
For GT Bank, as we're running the treadmill, we always expect them to grow revenue. For them, we expect that, okay, maybe you grow your top line and bottom line mildly, let's say some strong single digits, something like that. We didn't expect that, but then we know that this is a period where they didn't expect. First thing is looking at their fees and commission. Fees and commission declined by 34%. And it's majorly because, this is a period we expect that, they should grow volume. People should seek alternatives to cash and all. However, because they have a lot of their customers as retail customers, that means that a lot of them will be doing below 50,000 naira in transactions. That means that the charges they're going to get on this will be significantly low, despite the growing volume. The fees and commission reduced by 34%. So that's one thing to note in there. And also, looking at the, apart from fees and commission, looking at their cost-to-income ratio, they have cost leadership in this industry. We saw cost-to-income ratio rise above 40% to 43%. So this is something that we think they need to focus on and try to look at how to drive down costs, because we know them for cost leadership in this industry.
But do you think the increase in marketing expenses as well as statutory charges like that of AMCON and NDIC fees have anything to do with these declines as well?
Well, if we were to pick all these things by one, we could also say, could it be that if the yield on earnings assets were some basis points higher, would they have been able to record profits? If the impairment charges were not above 200%, would they have been able to record more profit? If the operation expenses were a little lower, would they have been able? So there are many scenarios that we can bring together to play to. So it's not necessarily AMCON fee, not necessarily marketing fee. In fact, I think this is a time where, as a bank, this unprecedented time in history is a time where you can come out and show that and grow your brand equity. And I think GT Bank has done this during this time. So all those ones have been helping them to grow their brand equity. And I think this is outstanding. So it's not really about that. It's a whole lot of things together. not just about the AMCON fee, the marketing fee. And
now, as for Access Bank, now we saw operating expenses increase substantially in H1 by about 40% to 174 billion, given the effects of the consolidation with Diamond Bank. But does that in any way explain the marginal decline in profitability?
To a large extent, yes. Because given the merger, one thing we would expect from a merger is cost synergy. The fact that both of you are able to come together, able to share resources, and sharing resources means that you're able to keep down your cost. So when your cost is growing at over 40% and your gross earnings is growing by 22%, it shows that there's something in between that needs to be more efficient. So this shows that there's a need for the bank to look inward and try to clamp down on rising costs. There's need to focus on these things. They need to clamp down on rising costs. Not only this, there's also the need to reshuffle their assets going forward, reshuffle their interest-earning assets so that they can be able to grow the top line much more than they are doing now. I mean, I think that apart from you just growing your top line, there's also a need to clamp down on costs. Cost running 40%, revenue running 22% means that there is room for efficiency in that aspect.
Now, just before I let you go, let's talk about UBA. Of course, UBA had a weaker performance for the period. Any idea what actually reduced their output?
First, the results was underwhelming, and looking at it, it's majorly about their OPEX. OPEX increased a lot. It was not expected. The interest income was weak, and all these things coming together, it all boils down to cost. What I would expect to see from UBA this period is to reshuffle their interest-earning assets. When they do this, then also to clamp down on costs, the operations cost of the company. So clamping down operations costs and also trying to reshuffle their interest-earning assets so as to earn more interest in this period are things that I would like to focus and like them to see in this period from UBA.
Now, but how much scope of gains for net interest income growth do these banks actually have for the rest of the year, considering the reviewed minimum rate on savings deposits of 10% of the MPR, which the CBN just issued last week?
Also, I think this is a policy that was born out of the 60 days period where the CBN chose to look at this, to reassess these banks. And I think it's impressive. Given that the yield environment is lower, it only makes sense for them to cut down the savings rate from 30% of MPR to 10% of MPR. So I think this will help the banks to lower their cost of fund, which there's something they're trying to work on before. This will help some banks to lower their cost of fund, try to increase the net interest margin. This is something in the right direction for the banks and also for the economy, for people to put more money into investment, put more money into the economy instead of trying to save it.
But going forward now, where do you see the core income for these lenders, given the investment security space is not so beneficial for the institutions anymore?
Well, for banks, you just have to look for a way to deploy your fund. We know that the CRR was increased by 5 basis points. The policies are all coming in. You just have to find a way to deploy your funds. So one thing I would like to see them do is they need to grow more deposits. If the CBN is taking 27.5%, and sometimes the discretionary CRR comes into play, and the CBN just looks at your liquidity, I'm like, you have a lot of liquidity, I want to debit you. That means that you need to grow your deposits more rapidly so that you can grow your interest-earning assets, and you can grow your interest income. This is something I'll be looking forward to, and also in part of the non-interest income. I would love to see these banks come together and try to grow transaction volumes. I mean, this is a period where we see people have the tendency to move away from cash to mobile payments and things like that. I would love to see the banks put more energy into it and try to grow volume, despite the fact that the rates on electronic transfer has been reduced. I'd like to see them grow volume.
All right, partner at Gifted Analyst, Mr. Samuel Adebisi, thank you for coming on the program this morning.
Thank you.